This is Next Week in 5 minutes. We separate noise from signal. 1 week, 1 clear framework, 5 forces: inflation, the Fed, policy risk, market rotation, key earnings. Here's what actually matters.
Welcome back. Last week, markets gave us drama, relief, and then fresh uncertainty, all within 5 trading days. The Fed held rates steady at 3.5% to 3.75%, and investors quickly realized this is not an easing cycle. It's a waiting game.
The January meeting minutes showed real division inside the Federal. Most officials support pausing further rate cuts until inflation clearly improves. A few even floated the possibility of rate hikes if price pressures stay stubborn. That got bond traders' attention fast.
Chair Jerome Powell repeated the phrase markets now know by heart, data dependent. There was no hint of QE. Quantitative tightening continues quietly in the background. Liquidity is not expanding. The training wheels are still off.
Early in the week, sentiment felt cautious. GDP came in soft at 1.4%, partly distorted by the government shutdown. Ad hawkish Fed minutes and rising geopolitical tension with Iran, and risk appetite cooled noticeably. Then Friday changed the tone. The Supreme Court blocked part of former President Trump's emergency tariff policy. Markets interpreted that as reduced trade risk, and we saw a relief rally into the close. But the story didn't end there.
Trump quickly proposed a new 10% global tariff framework, injecting fresh uncertainty. So while Friday felt optimistic, investors know the tariff conversation is far from over. Trade policy remains a live wire.
Rotation defined the week. Investors trimmed exposure to some high-valuation AI names and shifted toward industrials, communication services, and defensive sectors. Communication services led, up nearly 2%, while semiconductors rebounded with Nvidia strength.
Leverage usage appeared more cautious. Margin appetite isn't collapsing, but it's more measured. The market mood shifted from aggressive momentum to selective positioning. That's not bearish, but it's definitely more disciplined. Now let's talk about the week ahead. The calendar is heavy with macro data, and inflation will be the central theme. Monday brings factory orders. Tuesday may deliver updated consumer confidence data.
But the real spotlight lands on Friday's Producer Price Index. Core PCE has been sticky around 3%, so markets are sensitive to any sign that upstream price pressures are reaccelerating. A hot PPI could quickly shift expectations.
If producer inflation surprises to the upside, Treasury yields likely rise. Higher yields compress equity valuations, especially for growth stocks priced on future cash flows. Tech would feel that pressure almost immediately.
On the other hand, if PPI cools meaningfully, it strengthens the case that inflation is gradually normalizing. That could stabilize yields and support risk assets. This data release could set the tone for the next several weeks. Next, Fed communication. There's no formal FOMC meeting, but several policymakers will speak, including Waller, Bostic, Cook, Barkin, and Collins. Markets will parse every word for nuance.
Right now, futures markets imply very limited rate cuts in 2026, perhaps 2, possibly fewer. If speakers emphasize inflation risks and reinforce a pause or even tightening bias, yields could climb further.
A hawkish tone would likely pressure high-duration equities and reinforce the recent rotation into value and defensives. Growth stocks remain sensitive to even small changes in rate expectations.
However, if officials acknowledge improving inflation dynamics and sound balanced rather than aggressive, markets may interpret that as stability. Tone matters. Even subtle shifts in language can move billions of dollars. Geopolitics and tariffs remain another risk layer. While the Supreme Court limited part of the emergency tariff authority, new tariff proposals remain on the table. Implementation details will be watched closely.
Retailers and manufacturers with heavy import exposure are particularly sensitive. Higher tariffs translate directly into margin pressure unless companies can pass costs to consumers, and that's never guaranteed.
At the same time, tensions involving Iran keep energy markets alert. Oil volatility can ripple across sectors, influencing inflation expectations and corporate cost structures. Energy stocks may see heightened movement.
In short, trade policy plus geopolitical uncertainty equals headline risk. Even if fundamentals hold steady, sudden policy shifts can drive short-term volatility. Markets dislike ambiguity more than bad news. Now, let's discuss market rotation and sentiment. Money has quietly been moving. Some high-beta AI names have cooled, while industrials and defensive sectors have absorbed flows.
Approximately $52 billion has flowed out of U.S. equities this year, with capital rotating overseas. That doesn't signal panic, but it does suggest global diversification is gaining favor.
Watch influential voices. If Cathie Wood reiterates bullish AI projections, momentum traders may lean back in. If Michael Burry posts another cryptic warning, volatility could spike briefly.
Meanwhile, traditional value strategies, think Buffett-style discipline, may regain appeal if rate uncertainty persists. This environment rewards balance, not blind enthusiasm. Finally, earnings. The season is largely winding down, but one company stands out, Nvidia. Its upcoming report could significantly influence broader tech sentiment.
Nvidia has become the market's AI barometer. Strong revenue growth and confident guidance could reignite enthusiasm across semiconductors and cloud infrastructure names.
However, expectations are elevated. When valuations are rich, even solid results can trigger sell-the-news reactions. Investors will focus heavily on forward guidance and capital spending trends.
If Nvidia delivers both growth and sustained demand signals, the AI narrative remains intact. If guidance softens even slightly, rotation into defensives could accelerate. So here's the big picture. Inflation data, Fed tone, tariff developments, and a key tech earnings report converge in 1 week. That combination almost guarantees elevated volatility.
If inflation moderates and Fed speakers avoid hawkish surprises, markets could extend their rebound. Stability in yields would provide breathing room for growth stocks.
If inflation surprises higher and policymakers emphasize caution, yields could rise again, tightening financial conditions and increasing downside risk for equities.
The market isn't broken, but it is sensitive. Fragility doesn't equal collapse, yet it demands respect. Watch the data, watch the tone, and manage risk accordingly. We'll see you next week.
The market rewards preparation, not prediction. Manage risk, stay curious. Same time next week, 5 minutes. Please subscribe our channel, leave your comments, and let us know what you think.
See you next time.